Welcome everyone to FXstreet. My name is Adam Rosen. Very happy that you could join us here today. Today we have, in about 30 minutes, a very big economic number. U.S. GDP, gross domestic product, will be released. This is one of those few very, very significant economic numbers that has a direct impact to the U.S. Stock market, bond market, U.S. dollar, and the possible future implications to the Federal Reserve as far as what they may or may not do. That's expected at 8:30 a.m. Eastern in about 30 minutes from now. By the way, the chart we're looking at is the Dow Jones Industrial Average. Notice, all I did really is I drew a vertical line here at the beginning of each month to sort of mark off the trading activity, the personality of the Dow on a month-to-month basis. Notice at the bottom we have the ATR average true range, which shows us the state of volatility in the market. And at the very bottom we have volume. Notice that in the month of May, we've seen more volatility, more volume than we've seen, well, pretty much all year. And going back into the latter part of last year as well. Why is this happening? Why is the volatility coming back? It's not necessarily earnings season because that's past. Earnings season is every quarter, January, April, July, and October. So we really don't expect corporate earnings to move the market until July. Now, I have my own theories. There's a couple of reasons why this could be happening. Personally, I think this has to do with the possibility of stimulus ending. Now, let's take a look at this, by the way. Okay? The following chart, or it's actually a website. This is the Federal Reserve website, and this ties in exactly to what we're going to talk about today, which is GDP. And their last meeting, April 25th of this year, Federal Reserve met. They kept interest rates near zero. They kept their bond purchase program in place. They released the projections moving forward. This is how the Federal Reserve believes the economy will behave for the remainder of the year 2012, 2013, 2014. They cited three specific figures, economic barometers. GDP. In this year, let's focus on what they project this year to be. This year, the Federal Reserve expects GDP to come in the range of 2.4 to 2.9%, and that's an improvement. That's a little bit higher from January's projection of 2.2 to 2.7. So the Federal Reserve expects GDP, gross domestic product, to be this year 2.4 to 2.9%. Well, now we go to our trusty FXstreet Calendar, which is right over here. There's a link. U.S. GDP, remember, we're looking for 2.4 to 2.9%. Last month, we were at a 2.3, or we were expecting, I believe, it was a 2.3. The actual number was 2.2%. It was a disappointment. Remember, this needs to be 2.4 to 2.9 in order to satisfy the Federal Reserve. Now, what happens if it comes in below estimates? Federal Reserve is more likely to give us another round of stimulus. If it comes in at or above, if it comes in at estimates, 2.4 to 2.9%, chances are we're not going to get any more stimulus. And if it comes in above estimates, we're definitely not going to get any more stimulus. And there's more of an anticipation of higher interest rates in the near-term future. When we talk about stimulus, we know that the Federal Reserve enacted quantitative easing 1, quantitative easing 2, and now we're in the third round of stimulus, which is also known as Operation Twist. Each round of stimulus has a slightly different design as far as what part of the economy it's targeting. But essentially, with not with every single round of stimulus, but in most cases, these stimulant efforts, these huge amounts of monetary policy that are thrown into the economy are intended to stimulate the economy, to put stock prices up, to have the GDP number improve, but it tends to dilute the dollar. It tends to weaken the dollar because the Federal Reserve has to print more dollars in order to stimulate the economy. We're going to buy back bonds. We need money to buy back those bonds. We want to buy mortgage-backed securities. We need money to do so. Now, it's not necessarily the case in Operation Twist, but it's generally considered a rule of thumb that if the government gets involved in more stimulus measures, it tends to dilute the dollar and tends to push up stock price, tends to improve the economy. So we can make a direct correlation. We can say, well, if GDP comes in today, let's say it disappoints again. Again, remember, we're looking for 2.4 to 2.9%. Last month we had a disappointment, 2.2%. Let's say it comes in even worse today. Let's say 2.0%. What does that mean? Federal Reserve less likely to raise interest rates. They can't cut because we're already at zero, but they're more likely to introduce another round of stimulus, and therefore we're more likely to see the dollar, I would say, go down. Conversely, if the number is much better than expected, let's say it comes in at 3.0%, well, obviously less likely that we're going to have more stimulus, more likely that the Federal Reserve is going to raise rates sooner than expected, and therefore to expect to see a stronger dollar. Now, that's how the dollar behaves. But what will that do to stocks? Well, stocks, we could see a somewhat opposite. Now, I don't know if it necessarily it's going to have an immediate effect, but if you rationalize this out, we could see a somewhat opposite effect to the stock markets. The stock market goes up not because of macroeconomic conditions. It'll react to macroeconomic conditions. GDP is better than expected. Traders may take that as a sign, a vote of confidence. Say, hey, GDP is better than expected. That means the economy is strong. Let's buy some stocks. But over the long term, why do stocks go up? Because we anticipate better than expected corporate earnings. When does a company improve their corporate earnings? When does Facebook make more money, or Apple? Well, when there's a better environment. A better environment needs stimulus. So while stimulus is bad for the dollar, essentially it's good for stocks. Let me show you what I mean. I've been studying this quite a while, so I'll put together a number of different charts, okay? So first of all, here are the 3 rounds of stimulus. And by the way, these charts are available on FXstreet. We put together a number of articles. I have those links for you as well. Okay. You should see here, this is a picture of a chart that I put together a little while ago. Okay, on the left-hand side, we have, this by the way is the dollar Swiss weekly charts. On the left-hand side, we have quantitative easing 1. That was the first round of stimulus. Then we had that period of time that followed quantitative easing 1. During quantitative easing 1, we can see the dollar Swiss started out near 122, almost 123, came down to lows of near parity, 10000. After quantitative easing 1, the dollar rallied to the upside. And I know we eventually did turn back down. This could be perhaps, I think, that the dollar traders, those traders involved in the dollar Swissy, anticipated another round of quantitative easing. Nevertheless, as soon as quantitative easing was lifted, the stimulus was taken away, the dollar popped back up. Quantitative easing 2, take a look to see what happened in the dollar Swiss. We started out near parity, 10000. By the end of QE2, we were down near 8280, let's say 8300. That's 1700 pips down during QE2, and you can see this trend was pretty consistent. And what happened after QE2? The dollar bottomed out and began to rally. Now we have Operation Twist. Now it's important to discuss. Operation Twist is a little bit different. I know we're supposed to talk about GDP today, so I don't want to get too sidetracked with these different rounds of stimulus. But essentially the difference between Operation Twist and the first 2 rounds of quantitative easing is QE1 and 2 involved printing dollars to buy bonds. Operation Twist, they did not print dollars. They sold the bonds as short-term maturities. They bought the bonds with long-term maturities. So we're talking about the Federal Reserve adjusting the balance sheet. The balance sheet is basically they have a massive portfolio of bonds, the way we might have a portfolio of mutual funds. They have a portfolio of bonds with a long-term maturity, 10 years, 20 years, 30 years, and short-term maturity, 6 months, 1 year, 2 years, etc. So what they did is they went to the portfolio, they sold all the bonds with the short-term maturities. They used that money to buy bonds with long-term maturities. What they're trying to do is compress the yield curve, push short-term rates up, push long-term yields down, make it in order. And all of this is with the intention of pushing the customer, pushing the consumer back into the economy. Make it more attractive to buy a house, to buy a car, a refrigerator, a big-ticket item, because long-term interest rates are low. By the way, anybody see the 10-year bond yesterday? New historic lows. Nevertheless, we can surmise that during Operation Twist, the dollar didn't necessarily go down because we weren't printing as much dollars, but there was a direct correlation to other markets. Specifically, take a look at now the Dow Jones Industrial Average during the same rounds of stimulus. QE1, look to see what happened with the stock market. This is the Dow Jones Industrial Average weekly chart. QE1, Dow Jones Industrial Average came off lows of 6,300, ended 10,900. Of course, we know it's not only QE1. I mean, this followed the 2008 crash. But it's easy to say that, yeah, QE1 was probably good for stocks. QE1 ended, we hit highs of 11.3, and almost immediately we came down to 9,500 Dow Jones Industrial Average. Said, we need some more help. QE2 started. The Dow was at 11.3. We went up to 13,000. QE2 ended. Remember last summer, almost a year ago, July, August, with that debt ceiling crisis, and a lot of us, I think in part they were to blame, that debt ceiling debate where Congress could not agree on whether, to cut spending or raise taxes or a combination of both to stop the debt ceiling. And eventually Standard & Poor's reduced the U.S. credit rating from AAA to AA+. Well, remember what happened? The stock market went down very, very fast. We were at highs at 13,000, and almost immediately we went down to 10,400. It was a very fast move last August. Well, guess what happened last August at the same very time? This is a very small piece of time that we did not have any stimulus. QE2 ended. Operation Twist started. Now, it might not affect the dollar the same way, but certainly does affect stocks. Operation Twist started, 10,700. Well, it went up to 13,300, 13,400. Even now, 12,400. We're still well off the bottoms of Operation Twist. Why is all this important? Because Operation Twist is supposed to end in June, this month, tomorrow. Not necessarily tomorrow, but the Federal Reserve is scheduled to meet June 20th. And they have announced, time after time, that on June 20th, when they meet, they're going to say, we're going to keep interest rates near zero, and we're not going to have any more Operation Twist. It's over. We have had stimulus off and on since the latter part of 2008. The question is, will this be the last round of stimulus? If yes, what could we expect from stocks? Have you noticed how the stock market has been kind of weak over the past couple days and weeks? I think the stock market is moving in anticipation of no more stimulus. The stimulus, you think of it like medicine for a very, very sick patient in a hospital. If you give that patient medicine day after day after day, it may not necessarily make them better, but it's going to make them at least feel a little bit better. You take the medicine away, and all of a sudden that patient starts to feel sick again. Unless, of course, and we carry the analogy back to the economy, unless, of course, the economy starts to improve on its own. We should be asking ourselves a couple questions here. It's a really fascinating time that we're living in terms of, monetary policy and being a Fed watcher. But and I'll ask all of you this, has the economy improved? The economy specifically, we talk about GDP, the unemployment rate, also known as non-farm payrolls, where it's two different figures. Let's say the unemployment rate, GDP, unemployment rate, inflation. Is the economy better? Do you think that the Federal Reserve should enact another round of stimulus? If we do not get stimulus, what happens to the stock market? I'm guessing we go down. I think the stock market has already started to do that in anticipation. If we do not get more stimulus, what will happen to the dollar? This is the dollar, Swissy. Dollar tends to go down with stimulus, goes up without it. Also, remember, the dollar, there's a relationship between the dollar and the bond market. So when stocks go up, traders say, well, I don't need bonds because stocks are going up. My Facebook stock is going up. Apple stock is going up. So let's sell bonds. When you sell bonds, bond yields go up. When you buy bonds, bond yields go down. By the way, I know I'm jumping around a lot, but this is all really interesting stuff here. Take a look at this chart. This is the symbol on Bloomberg is USGG 10-year. That's the link. That's the symbol for the 10-year U.S. Treasury bonds. Yesterday, it hit lows of 1.59%, which is the lowest low on this chart, and in fact is the lowest low, I believe, going back to 1953. Now remember, quantitative easing 1, quantitative easing 2, Operation Twist, they might have gotten the capital from different sources, but at the end of the day, their intention was to buy long-term bonds. Why are they doing this? Because they want to push those yields down to make bonds very unattractive. They want you and I and investors and traders and consumers, they want us to say, hey, why am I going to buy a bond? I'm getting 1.6%. That's nothing. Let me buy stocks. I'm going to get a better return. Let me buy a house. That's a good investment. Let me take my money and invest in a new business. Let me take my, business and through merger acquisition and, buy another business. Let me do something else without keeping my money in the bond market or in a savings account because, well, I'm not getting anything. I'm getting 1.6% yield. That's what the Federal Reserve wants. That's why they're buying bonds. They're buying bonds to push us, to dissuade us from buying bonds. You think it's working? I think so. 1.6% yield on a 10-year bond, that's below inflation. That means if you buy this bond, you're actually losing money. Now, okay, so the question is now, do we think that, and we're watching the calendar very close, okay, it's 8/17, so with ADP employment change figures, 133,000, a little bit less than expected at 148. There's not a direct correlation between ADP employment numbers and non-farm payrolls, which is due tomorrow, by the way. Oh, yeah. So let's get back to the Fed's projections, right? So, again, Federal Reserve projected that GDP should come in 2.4 to 2.9%. Last month, we were expecting 2.3. It was a disappointment. It went down to 2.2%. The unemployment rate they're expecting to fall in the range of 7.8 to 8.0%. And then finally, we have the PCE inflation figures. And the PCE specifically, we talk about inflation. We talk about either the consumer price index. Whoops, wrong chart over here. Or PCE, which is basically consumption. Let me look for, you know what? I have a good chart to show you. So let's see here. Okay, so I know what to show you. Okay, so first of all, let's take a look at GDP. Well, let's first take a look at the dollar Swissy. Then I'll show you GDP. Okay, so this is a dollar Swissy chart. It's a screenshot of a dollar Swissy chart, so it's not, updated till today. Please let me know if you can't see this. But this shows us significant events that we're watching. Overlaying those or comparing and contrasting to the Fed's projections, and finally to see how the market has behaved. Now, on April 25th, remember, that's when the Federal Reserve released their projections. Now, for whatever reason, the foreign exchange market said, you know what, okay, the Fed projections mean this or that. The dollar Swiss went down a little bit. The next big number was the U.S. GDP number. Remember, that was a disappointment. What does it mean? Federal Reserve is less likely to raise interest rates, more likely to initiate another round of stimulus that we knew is set to end in June. As GDP disappointed, the dollar Swiss went down, pretty big red candlestick. This is a very logical move. On April 30th, we had the PCE, personal consumption expenditure figures. In other words, inflation. Now, we can look to see exactly what that PCE number was, but the dollar Swiss is basically unchanged. After that, on May 4th, we had non-farm payrolls. That was a disappointment. Now, remember, the unemployment rate went down, but non-farm payrolls disappointed. So which one do we look at? Was this a good day or a bad day? Well, the dollar Swiss went up. The dollar Swiss went up as a result of this employment figure. The dollar Swiss went up, I think, in my opinion, as a result of the market believing that the stimulus is over and that we're closer to raising interest rates sometime in the future. This was when the unemployment rate went down. Remember, going back to the Fed's projections, we have a projection for unemployment rate at 7.8 to 8.0%. If we remember what was non-farm payrolls, that was actually the unemployment rates. Here's a calendar, which is expected again tomorrow. The actual unemployment rate, we also have PCE, personal consumption expenditure figures tomorrow as well, was at 8.2%. I believe it dropped down to 8.1%, if I'm not mistaken. So this number was actually better, and I think that's one of the reasons why the dollar Swiss went up. Although when I say that, it's kind of silly because I think the market is smarter than that. I mean, most analysts agree the unemployment rate went down only because there's a smaller pool of individuals counted in the survey. The unemployment rate, the non-farm payrolls, it's a very imperfect science. Basically, analysts say that, well, there's less people that are looking for a job, therefore we're counting less people, and the people that we are counting, more of them are saying, yes, I am working. Because what they do every month is they call 100,000 people across the country at random, and they ask them, are you working? Yes? No? Are you looking for work? And then they take all those numbers, put it together. But if somebody picks up the phone and says, no, I'm not working, and no, I'm not looking for a job, maybe the Federal Reserve or the Treasury, or whoever it is making all these phone calls, they probably say, oh, well, this individual probably won the lottery, or they're independently wealthy, or they don't need the money. They say they're not actively looking for a job. Maybe they don't need it. Maybe they have $1 million trading Forex, right? So those people are not counted in the survey, and I think that's why the unemployment rate went down. So I find it hard to believe that the candlestick went up only because the unemployment rate went down, but that's what it looks like. We had the consumer price index that was unchanged, and dollar Swiss went up on May 15th. Okay, that's as far as this chart will take us. But we have better stuff here. And we have GDP right around the corner. Remember, ultimately, we're trying to ask ourselves a question. Okay. Let's take the last step and go backwards. The answer that we're looking for is, what is the market going to do? Is the dollar going to go up or the dollar going to go down? Are stocks going to go up or stocks going to go down? Because we're traders. We want to know if we should buy or sell. Well, take a step backwards from that. We say, well, we know that during rounds of stimulus, generally speaking, stocks tend to go up and the dollar tends to go down. So if we get more stimulus, I would want to short the dollar and go long stocks. If we don't get more stimulus, short stocks, go long the dollar. That's what history has taught us so far. Well, now we have to take one more step back and say, are we going to get more stimulus? That's why we looked at the Fed's projections, which, again, are over here. If the numbers beat the Fed's projections, we're not going to get more stimulus, which means I expect the stock market to go down. I expect the dollar to go up. So far, GDP has disappointed. The unemployment rate, well, we're not at 7.8 to 8.0%, but we're heading in that direction. PCE, 1.9 to 2%. Well, we're going to take a look at those figures. So ultimately, we should be watching the economy because the Federal Reserve is watching the economy. The Federal Reserve tells us what they're going to do. The dollar and the Dow and the other markets follow listens to the Federal Reserve. The Federal Reserve is listening to the economic numbers, so we should listen to the economic numbers. Here's a chart. Please let me know if you can't see it. This is updated on a monthly basis. This is my own chart, so it may not be, 100%, accurate. I believe it is, but I don't adjust this chart for revision. So this is the core. This is not the core, but these are the figures as they're released. I don't revise my figures the way the Federal Reserve does. But we can see during quantitative easing 1, this is GDP updated on a quarter-over-quarter basis. During QE1, GDP went up. We were down on levels of negative 6.6%. This was in the very, very bleak days of 2008 and 9. 2009. Quantitative easing 1 ended, and GDP was already all the way back up to positive 6%. Now, obviously, this was just the rate of change. Doesn't mean the economy is necessarily expanding at 6% on a yearly basis. This is just a rate of change. But what's important to make note of is that QE1 ended, GDP slid off. QE2 started, and we had a little bit of a bounce up, but notice GDP really failed to respond to QE2. And for what I remember, QE2 was a very significant amount of bond purchases. I was actually kind of surprised when I put this chart together to find out that the GDP really failed to respond to QE2 the way it did at QE1. QE2 ended, and the GDP really stayed near the lows. It did pop up. Again, this is an imperfect correlation, so there's a lot of other factors at work. Operation Twist, GDP improved. This is the most recent round. This is from September of last year through May of this year, basically up until today, because today we're going to get another GDP number. That red bar on the right-hand side, is where the Fed projects GDP should be, by the way. So when we get into the month of June, GDP, which we're falling a little bit below right now, should come in near that red line. If we're below the red, more stimulus. If we're above the red, no stimulus, maybe higher interest rates. Here's PCE, personal core expenditure. We have a few minutes to go until GDP numbers are released, by the way. This is PCE and core PCE. Think of it as another way to look at inflation, like the consumer price index. It's how much we spend. The blue line is PCE, personal consumption expenditure. The violet line is core PCE. I believe the difference is the same as CPI, if I'm not mistaken. You take out the more volatile components of inflation, meaning food and energy. But nevertheless, we can see QE1, consumer prices went up. After QE1, prices went down. QE2, prices went up. After QE2, well, they didn't go down, but they settled off. But take a look at Operation Twist. The PCE started to really sell off. Here's the Fed's projections. While the core is going up, and the core excludes food and energy. So without food and energy, prices going up. With food and energy, they're actually going down. Maybe this reflects gasoline prices selling off. Nevertheless, the Fed's projections are right here. Finally, we're looking at the unemployment rates. Unemployment rate QE1 went up a lot. This is the worst days of the recession of 2009. Unemployment rate started to move to the downside at the end of QE1. After QE1, basically nothing. QE2, well, the economy really improved and the unemployment rate dropped. After QE2, it leveled off. Operation Twist, the unemployment rate dropped. The unemployment rate dropping, by the way, is a good thing. And afterwards, well, we're going to see. But we're basically at the Fed's projections right now. So you take a look at unemployment rate, you take a look at PCE, you take a look at GDP. I even have this for the CPI numbers as well, although we don't have projections because the Federal Reserve does not give us projections. The question now is, as GDP is about to be released, do you think we need it? Okay, we're waiting for GDP. Here's the FXstreet Calendar. 1.9% quarter over quarter, which is as expected, in line, 1.9%. Now remember, the projections by the Federal Reserve is 2.4 to 2.9. So we came in line. That is not good news. I mean, it is as expected. But who's expecting? That just means that all the analysts and economists and, professional traders that they asked, FXstreet Calendar asks, a number of traders, and the Bloomberg Calendar asks different amount of analysts or whoever it may be. This just means they guessed correctly. I don't want to confuse this with, it didn't miss expectations. Analysts expected this to be bad. It is bad. 1.9% GDP is not considered, a sign that the economy is improving. I mean, you take a look at the chart. Let's go back to this chart. Sorry. You take a look at this chart. What's 1.9%? You can see here on the left-hand side of the scale. That's 0 in the middle. And remember, we're looking for 2.4 to 2.9%. We're in at 1.9. 1.9 existed in the middle part of 2008. After that big slide off, we came back up. 2%, generally speaking. Now, does anybody know what the target is for inflation in the U.S.? Is it 3%? In Europe, it's 2%. It's somewhere between 2 and 3% is where the central bank wants the economy to sort of behave. When anything above 3%, we start to see too much inflation. Anything below 2%, we don't see enough inflation. 1.9%. That is not good, because I think that falls very much short of where the Fed's expecting the market to be. Again, take a look. I hate to overemphasize this, but I think it goes without saying. This is where the Fed, as far as April 25th, this is not ancient history, within the past month, this is where the Federal Reserve expected the GDP to be this year, 2.4 to 2.9. We're at 1.9. 2013, the Federal Reserve expecting 2.7 to 3.1. 2014, 3.1 to 3.6. We're at 1.9. We're not only pretty far away. I mean, what percentage point, when we're talking about this kind of stuff, is a really big deal. But we're heading in the wrong direction. Here's a dollar Swiss C. Now let's see if I'm right. My guess was that this number was a disappointment. It means the Federal Reserve is less likely to raise interest rates, more likely to give us some kind of additional round of stimulus. And we said, well, more stimulus, that's bad for the dollar and good for stocks, right? Well, the dollar right now is going down. 96.76, and this is a 5-minute chart. The dollar Swissy, it's not going down a lot. I wouldn't necessarily place a trade on this. I happen to think long-term the dollar goes up. So I may, personally, I might, if the dollar goes down enough, I would use this as to position myself, to buy dollars. But the immediate market reaction is the dollar's going down. I think because a lot of traders are saying, you know what? Yeah, the economy is not doing well. 1.9% GDP. Put the champagne away. This is not good stuff. So that means we're probably going to get more stimulus, and which means that, the dollar's probably going to go down. Dow Jones Industrial Average Futures. If we have more stimulus, think of it if you're running a company, a publicly traded company, you say, great. That means interest rates are going to be at 0 for a longer time. And we're probably going to get more stimulus, which means they're going to buy back bonds. That means if I work at a retailer, someone's going to come in, they're going to want to buy a refrigerator because interest rates are going to be low. If I work at a car dealership, someone's going to want to buy a car. If I'm involved in the housing market in some way, well, somebody's going to be really incentivized to buy a house because mortgage rates are going to be lower longer. And ultimately, this is good for corporate America. But to an extent, we want to see, if we're working in any kind of business, whether we're selling refrigerators, cars, or homes, we want to see the economy improve. We don't want to see a bad economy in order to see the stock market go up. I mean, make no mistake, I think the stock market is going up now because of the immediate expectation that we're going to get more stimulus. And the same way that, you know, if we have a small child and the child starts to cry, we give him a piece of candy. Well, then the baby will stop crying because we're giving him candy. But that's not a recipe for a long-term diet. You can't just, you know, give a child candy every time he starts to cry. That would ultimately be bad. I would carry that analogy forward to the stock market as well, or to the U.S. economy as well. Quantitative easing 1, quantitative easing 2, Operation Twist. On the short term, that makes the economy feel better, but you know, you don't get something for nothing. I don't necessarily think that these rounds of stimulus, although they've supported the stock markets in the short term, over the long term, I'll ask you the question again. Do you think this has helped us? I mean, you take a look at GDP, and remember, I didn't update these charts yet, but today's number is 1.9%. Before anybody was talking about stimulus, pre-recession, we had GDP at 2%. Coming into the recession, we had a negative 2%. This is what happened with QE1. GDP went up. After QE1, GDP went down. QE2, GDP initially went up, but then kind of ignored the stimulus. After QE2, GDP leveled off. Operation Twist, GDP went up. We did not go up as much as we did during QE1. And now we're below estimates. So we're literally, you know, I don't think I can be more clear with this. We're about to conclude the third round of stimulus, or a lot of people say could be the last round of stimulus. And the GDP numbers, which is basically a very important economic barometer that allows us to test the condition, the health report, the report card of the economy, the report card is telling us, you know, things are not that good. What does that mean moving forward? What does that mean in terms of these rounds of stimulus? I mean, there is a deteriorating effect. The fact that in the beginning, stimulus was very helpful to turn the economy around, but it's losing its effect. It's like if you give a patient too much antibiotics, eventually they grow an immunity to it. I think the U.S. economy is starting to develop an immunity to stimulus. Now, you made a great point. Now, well, the Fed said 2.4 to 2.9% GDP. We got 1.9%. That's logical to expect we're going to get more stimulus. Now, I don't think it's going to be immediate because if you notice, every round of stimulus, the Federal Reserve took their foot off the gas pedal, so to speak. I know I'm speaking a lot of analogies and puns, but I hope helps paint the picture. After every round of stimulus, they took their foot off the gas pedal and they said, let's wait. Let's see how the market behaves without it. We've given the economy a lot of medicine here. Let's take the medicine away for a while and see what happens. GDP sold off. QE2, then let's take the medicine away and see what happens. Operation Twist, I think they're going to take the medicine away for a while and see what happens. Now notice, after QE1, well, this was March of 2010 to literally October of 2010, we had a 7-month span with no stimulus after QE1. After QE2, we went from May of 11 to September of 11. Well, we had about, 6 months span? So the period of time that we waited post-stimulus has become shorter and shorter. It's almost like the Federal Reserve is saying, uh-oh, look what happened. We took the stimulus away, put it back. No, put it back faster. I think, my opinion, I think June 20th comes around. Federal Reserve is going to meet. Ben Bernanke is going to speak. He's going to say, we're keeping rates near zero. That we all expect. And I think that he's going to announce that they've concluded Operation Twist. And we're going to enter another post-stimulus era. How long that lasts, I think that has that really depends on how the economy behaves and how the stock market behaves, which I think is a mistake because Alan Greenspan, Bernanke's predecessor, was very clear in saying the Federal Reserve is not in charge of regulating stock prices. The Federal Reserve is in charge of the dual mandate, consumer price index, basically to moderate the rate of inflation, make sure things don't get too expensive or too cheap. And number two, create an environment that's conducive for job growth. Basically, lower rates to improve the job market and lower prices, raise rates to slow the economy down if we enter another bubble. Not to influence the Dow Jones Industrial Average. Unfortunately, my own opinion, I think that that's changed. I think that the Federal Reserve is much more responsive now to the stock market. June 20th, Federal Reserve is going to meet. I think that they're going to conclude Operation Twist, and we're going to say, okay, let's see what happens for the next couple months. That will be a very important period of time. June, July, August. Now, you want to throw more into the picture. June, the Supreme Court is coming back with a decision on whether the Obama administration's health care plan will be deemed constitutional, not constitutional. And, obviously, if it's allowed to exist, if it's deemed constitutional, a lot of those costs start to kick in early next year. That could be perceived as a drag to the U.S. economy. We also have elections, presidential elections, coming towards the end of the year, which always creates a lot of uncertainty in the markets. So I think that just very crucial. The markets have been kind of slow for most of the year. I think volatility and volume is going to start to come back. And also we have July earnings season. Don't forget about that either. If things really get bad again, and when we say things, GDP, PCE, unemployment rates, if those three numbers the Federal Reserve is watching, and we're going to compare those to their projections, so we can guess if the Federal Reserve is going to, enact another round of stimulus, that's going to really determine, I think, which way markets go. Now, the question is, will there be another round of quantitative easing, Operation Twist, or maybe something completely different? I think it's going to be something completely different. Why not quantitative easing 3? Quantitative easing 3, by the way, the 10-year bond yield is at 1.59%. We're basically new lows since 1953. If that tells you anything. Now, why not quantitative easing 1? Why not quantitative easing 3? QE1 and QE2 involved buying long-term bonds to push the bond yield down. I think it was a little bit of a variation between quantitative easing 1 and 2, but essentially they're buying long-term treasury bonds, and they're printing dollars to do so. But when they print dollars, what happens? It dilutes the dollar. It's like a stock split, but you don't get any more stock. Well, this became very, very unpopular because remember, if you print more dollars, your dollars have more dollars to compete with, and that means your dollars have a little less buying power, which means everything becomes a little bit more expensive for you. If I have $100 in the bank before quantitative easing, and I have $100 in the bank after quantitative easing, I can buy less with that $100 after quantitative easing because there's more dollars out there. In other words, commodities go up. That's why gold went up so much. That's why oil went up so much. Take a look at QE1. Oil through the roof. After QE1, oil sold off. QE2, oil exploded. After QE2, nothing. Not nothing, it went down. Operation Twist, oil went up, but oil did not make new highs. Why? Because Operation Twist does not involve printing more dollars. Remember, quantitative easing 1 and 2, they print dollars to buy bonds. Operation Twist, they sell short-term bonds to buy long-term bonds. That's why during Operation Twist, oil did not go up. Why did we not have QE3? Why did they go to Operation Twist? I think a big part of that is the unpopularity of quantitative easing 2 because oil went up so much. Oil goes up. We complain to our congressman. A congressman goes up to Ben Bernanke. They said, Mr. Bernanke, we think you're doing a great job, but stop printing so many dollars. You're killing us here. Oil is going up. So it says, you know what? Well, we tried something in the 1960s. It was called Operation Twist. Let's try that again. By the way, it's named after that song, The Twist, going back to the 60s. Because they're twisting the balance sheet. They're taking money out of the short-term bonds, putting it into long-term bonds. Now, so I don't think it's going to be QE3. What's wrong with Operation Twist? Well, you don't get something for nothing. I know I'm running short on time here, so I'll try to be very brief. But with Operation Twist, they're buying long-term bonds. That pushes bond yields down. They're selling short-term bonds. That means it sends the short-term bond yields up. When short-term bond yields, like a one-year bond yield, goes up, and the long-term bond yield goes down, what does it do to the bank? That hurts the bank's balance sheet. Because what does a bank do? They lend money out to me when I put my money into my savings accounts. That's short-term bonds. They allow me to borrow money at long-term bond yields when I take out a mortgage or buy a house. But when the difference between long-term bonds and short-term bonds diminishes, that means the bank makes less money in the mortgages and they have to pay more money out in the savings account. That means their balance sheet, the profit margin, decreases. Operation Twist is very bad for banks. Maybe this is why Bank of America is $7 a share. So I don't think it's going to be Operation Twist. I think we're going to get something completely different. Now, this is not me alone. I mean, this is something I've heard a lot of analysts talk about. But I think that the Federal Reserve is going to look at the economy and say, well, what's the weakest part of the economy? Arguably, that's the housing market. So they're going to say, well, let's do something to improve the weakest part of the economy, the housing market. I think it might take the shape of some sort of purchase of mortgage-backed securities. You know, when I buy a house, my mortgage goes into a pool with other mortgages, and all those are securitized, which means you take your mortgage and my mortgage and a million other people and make a security out of that mortgage, and you sell that security to somebody else. Say, hey, you want to invest in this mortgage? You want to bet that Adam's going to pay his bills on time? Buy the security. And if you believe he's not going to pay his bills on time, short the security. Now, this got a really bad name in 2008 because they took all the very high-risk loans, also known as subprime loans, packaged that into a security, you know, put a little nice bow on it and sold it to somebody else, and, you know, maybe they weren't aware of how dangerous those loans were, which led to the subprime mortgage catastrophe. But I think ultimately, and that still exists, we still have subprime loans. We still have those securities. Nothing has really changed. I mean, they've become very politically unpopular. But I think that the Federal Reserve is going to say, you know what, we're going to spend a lot of money. We're going to buy a lot of these bonds, mortgage-backed securities, and we're going to do that so the banks feel more comfortable to issue a mortgage. Because the bank is going to say, this is great. The federal government is buying these securities, which basically is the insurance on the housing market. And if the Federal Reserve is buying my insurance, or basically buying insurance for me, I'm going to give Adam a mortgage. And then, you know, I'm going to buy a house. I'm going to go to Home Depot. I'm going to improve the house. You know, I'm going to pay property taxes, and hopefully the economy will start to recover. Housing prices will go up. Home Depot will make more money, and everybody's happy. I think that we're going to have some time off from Operation Twist, which is set to end in June, tomorrow, or June 20th is when the Fed meets. I think that the markets are not going to like that, at least the stock markets. I think the dollar will continue to do well because the dollar is a flight to safety. We have only talked about the U.S. today. Don't forget that we have poor GDP numbers in Switzerland, I believe. I think they were pretty bad. Europe, enough said. You know, we have recessionary conditions in the UK, recessionary conditions in Spain and Greece and a lot of other places. So the dollar being a flight to safety, as long as there is not the perception that the Federal Reserve is going to print more money, we might get more stimulus as long as we don't get QE3. I think that's a recipe for a strong dollar. 10-year bond yields down, then the price is up from buying. Essentially, yes, the bond yield and the bond price goes in opposite directions. When you look at the bond, the way it's quoted, it's 1.59%. That's the yield. When the yield goes down, and the yield is going down today, that means the bond prices are going up. Why? Because traders are saying, uh-oh, this is bad. You know, the economy is really weak. GDP is a disappointment. I'm scared of owning stocks. I already lost a lot of money in Facebook stock. Sell stocks and buy something else. Buy something that's safer. Exactly right. It's a flight to safety. So many traders are looking for safety that they're sending yields down below the rate of inflation, which is unprecedented. Inflation is 2%. Traders say, I don't care. I'm happy with 1.6%. Why? Because it's better to lose 0.4 of a percentage point on the bond market than to lose 40% on Facebook stock or 60% on some other stock. And you look at the 10-year German Bunds, basically the 10-year bond yield in Germany, or no, I'm sorry, it was a very short term. They're basically at zero. So which is better, losing 2% against inflation or losing 50% if you own Greek bonds, or 70% if you own Spanish bonds, or 30% if you own Italian bonds? Let's buy the German bonds. You know, I might lose 2%, but 2% is a lot better than 20%. It's a flight to safety. With that said, I'm out of time. If you want to contact me directly, you can do so, www.foreinclowns.com. I want to thank you all very much for joining us. Very special thanks to FXstreet. Please see the calendar because we have a lot more to talk about. Again, we thank you for joining us. We wish you a great day, all profitable trades. And we look forward to seeing you back soon. Back in time.